what characterizes the business cycle that started with the rebound post-COVID-19? At one point, the word that would have been chosen would have been surprising, the surprising strength of the rebound. You could also think about frustrating because it was very difficult to come to grips with the inflation dynamics. At the current juncture, I would say that the word that springs to mind to characterize the current business environment and the cyclical outlook for the near term is slow. We have a slow squeeze, that means a slow transmission of monetary policy. We have a slowdown of economic growth. We have slow disinflation, and there is a prospect of a slow recovery. Central banks in advanced economies have tightened monetary policy very significantly and at a fast pace. We can think about the Federal Reserve, the ECB, the Bank of England. So that means that significant squeeze should weigh on economic activity, should weigh on credit demand. And yet the feeling is that the squeeze of the monetary tightening is slow. For instance, we also observe that capital markets-based financing is still rather fluid. Admittedly, what we observe is that in terms of bank-based financing, that the credit conditions that are being applied have been tightened, and also that the demand for bank credit has become slower. An area where that has been most visible is in mortgages, where understandably the very big increase in mortgage rates in Europe but also in the US has had a clear impact in terms of credit demand. One reason why the monetary transmission has been rather slow is that it takes time for these rate increases to feed themselves through the system, because it really depends on whether loans that have been given in the past are up for a reset in terms of interest rates, or whether everything depends on the new loans that are being taken out and the conditions that are applied. Nevertheless, we can assume that the rate hikes that we have observed in the past and that still are to come to some degree will end up having a more visible impact on economic activity. Another dimension of the slow business cycle is slowdown. That statement may be puzzling because, after all, we have seen very weak GDP growth on a quarterly basis in the first quarter in the US and in the euro area, and let's not forget that Germany is in a technical recession since the fourth quarter of last year. So why do I call it a slow slowdown? Well, for the very simple reason that the labor market continues to be under pressure. It continues to be tight. The hiring intentions of companies remain elevated, and that is because their order books are well filled. But another reason why the labor market is tight is because an important part of the economy continues to do well, and that is the services sector. The services sector is still very well in terms of business sentiment and in terms of volume of activity, and even the near-term outlook in terms of order positions. So the part of the economy that has suffered most from the rate hikes is really the manufacturing part, and the overall economic assessment is dominated by what is happening in services. Third dimension of slowness, slow disinflation. Disinflation is what central banks want to see. They want to see inflation converging to target, preferably as soon as possible. The good news has been, yes, inflation has declined. It is headline inflation, so the overall number that has declined on the back of a drop in energy prices. You strip out energy prices and you strip out food prices, which, by the way, early on in the year have moved higher, and you end up with core inflation. What is happening there? Well, a very limited decline from the peaks in terms of core inflation in the euro area, and even in the US, the decline in core inflation is still way insufficient in view of the Fed's objective. So slow disinflation in terms of core inflation, and that is to some part related to what is happening in terms of wage growth. Remember that I said that the labor market is still tight, is still under tension, and this is actually fueling this ongoing pace of wage increases. Another reason, of course, for these wage increases is that households have been confronted with a jump in inflation last year, and now they say, okay, I want to have some compensation for this unpleasant inflation surprise. Fast wage growth, that means that it is having an impact on the cost structure of companies, and it means that any company that is still enjoying pricing power will not hesitate to reflect these higher wage costs in the sales prices that are being applied. And surprisingly, central banks are focusing on that, and that is why the Federal Reserve in its recent communication to the market has said, well, clearly we have not hiked interest rates in June, but next time around we will probably hike them again, and why the ECB has insisted very strongly that the rate tightening cycle is not over, because more is necessary to make sure that inflation declines sufficiently swiftly to target. The current business cycle should end in the United States with a shallow recession, that is a short period of limited contraction of economic activity. Personally, I call it a look-through recession. In the euro area, we are more counting on a period of stagnating activity during a couple of quarters. And then beyond that, we will see a pickup, and then a new business cycle starts. Now, the early phase of that new business cycle will, guess what, also be characterized by slow. So we are anticipating a slow recovery. And why is that? Well, one reason is that if the end of the previous cycle, so what we're moving towards now, is actually characterized by something that is slowing down softly without any recession to speak of, certainly not in the euro area, then we can of course not expect that there would be a V-shaped recovery. Because to have a V-shaped recovery, a swift reacceleration, you first would need to have a major hit to economic activity. And that is not what we're anticipating. The second reason is that what is characterizing the behavior of companies in this cycle is labor hoarding. That means that companies that are actually struggling because they are faced with slowdown of turnover of top-line sales, they will still hold on to their labor force because they want to make sure that when the economy picks up, that they have enough staff. Keep in mind that many companies have been struggling to hire people in recent years. So they hold on to their labor force, they hoard labor, but it means that in the recovery, the pace of job creation will also be slower because the staff is already on board. And then the final reason is that the extent of rate cuts, which previously, when there was a slowdown, when there was a downturn, has been swift and massive, this time around it will be slow and very moderate. Why? Because inflation will take time to converge back to target. It's probably a story of early 2025. We think that even at the end of 2024 we will still be slightly above. So yes, there will be rate cuts in 2024, but central banks will not be in a hurry to do a lot in that sense. So to wrap it up, slow is everywhere. The good news is that it's a slowdown. It takes time. There's nothing panicky about it, but it also means that the expected recovery that will follow will also be on the slow side. Thank you for having joined us, and invite you to watch again next week. Thank you.